Are you a Web3 business that is struggling with your digital asset accounting? Well, I'm here to tell you that you're not alone. This is one of the most common problems that I see for Web3 businesses is not properly setting up an accounting system to track their digital assets, including cryptocurrencies and NFTs. The problem is that this is one of the most important areas for your business because without an accurate set of financial statements, you're not going to be able to make strategic business decisions. You're not going to be able to win the trust and confidence of investors, and you're not going to be able to accurately report and plan for your taxes. So this is an issue that you as a Web3 business owner need to solve, but it's not without its challenges. The Web3 space is new, and there are many nuances to developing a functional accounting system for your Web3 business. In this video, I'm going to go over a step-by-step guide and the best tips to establish an appropriate accounting system for your digital assets to ensure that you have accuracy across your reporting for business decision making and tax reporting purposes. The first step to establishing a proper digital asset accounting system is ensuring that you've integrated all of your accounting systems. What I mean by this is that you're going to have your digital asset accounting system, and then you're going to have your traditional accounting system that's more for your fiat transactions. How this can look is that you're going to have a digital asset subledger that will pick up all of your on-chain transactions for any incoming money that you receive in cryptocurrency, any outgoing spending that you do in cryptocurrency. This all will be tracked up on your digital asset subledger. Additionally, when you're making these various crypto transactions, you may also have capital gains due to the price validity for whatever crypto assets that you're holding. This would also get picked up within your digital asset accounting system in terms of calculating those capital gains. So that system we need to get integrated with your traditional system, which usually is going to be on QuickBooks or Xero or another more common accounting software that is going to connect into your traditional bank feeds. Now, the way that we integrate these two systems is via journal entries. So all of the digital asset activity needs to be either via automations, depending on the digital asset software that you're using, or through manual journal entries. We need to take all of the information that's taken place from a digital asset perspective and make journal entries to integrate that in with our accounting system on the fiat side, whether that's in QuickBooks or Xero. What this is going to enable you to do is have one true and accurate set of financial statements that you're going to need, again, for business decision making, for investors, and also for tax reporting purposes. So, I see a lot of companies sort of have a disconnect to this. Maybe they're handling their digital asset accounting, maybe they're also handling their traditional accounting, but they're not connecting the two, and they don't have one true set of financial statements. And this is important because we need that one set of financial statements to really get a clear picture of the company for whatever purpose it may be. Again, tax reporting if investors are looking at your business, or if you're just looking at business forecasting or business decision making. We need that one true set of financial statements, and the way we do this is by consolidating via journal entries your digital asset accounting system and your traditional accounting system. Inaccurate cost basis data in your digital asset accounting system can cost you big when it comes to taxes or when it comes to your business decision making ability. This is a persistent issue that I see when I'm working with new Web3 companies, is that oftentimes they're not properly tracking their cost basis data. Now, your cost basis when it comes to digital assets, whether those are cryptocurrencies or NFTs, those are tracked on a cumulative basis, meaning that if you were to purchase Ethereum or any other asset in a prior year and you hold that asset through multiple tax years, we're going to be carrying that cost basis data over for all of those subsequent tax years. Now, to the degree that that initial cost basis data is inaccurate, it can lead to those subsequent years that's carrying over that data to also be inaccurate. So it's very important that your accounting for your digital assets, number one, is started from the very beginning, and that it's done accurately with the right accounting methodology and tax positions, because any cumulative issue can carry over into future years. So, the number one way that I see this come up with Web3 businesses is they don't start from their very first transaction. They may say, hey, I had very limited activity in the prior year. I'm just going to get started with my accounting for the current year where most of my activity is, and I'm just going to go from there. And what that can lead to is they don't pick up a lot of that cost basis data from some of that initial activity where maybe they weren't making a lot of income, maybe they had some capital contributions or they purchased some crypto. All of that data needs to be picked up to accurately carry through your cost basis and to ensure that your balance sheet is accurate. So number one is, businesses not starting from their earliest transaction because they're not aware of this cumulative cost basis tracking issue. And number two would be accounting errors or bad tax positions that are applied to a transaction within your accounting system. To the degree that you do something inaccurate, again, it can carry through in that cost basis data. So it's very important to make sure that we start with the earliest transactions and that we get an accurate calculation through to the current period. This will ensure that your cost basis data is accurate and that your balance sheet data is accurate. Web3 businesses need to be diligent in reconciling 1099s that they get in their tax documents to their actual accounting records, to ensure accuracy and also that you're not overstating or understating your taxes. So even if you have a properly established and well implemented digital asset accounting system and everything is accurate, when it comes to tax reporting time, you may be receiving 1099s from exchanges which you've transacting on during the year that you've triggered capital gains. And you may also receive 1099s from exchanges or from third parties where you've received money as income or as capital contributions. And if this isn't reported correctly and reconciled against your accounting reporting, it can cause either overpayment in taxes, compliance headaches, or both. So step number one is when you're receiving a 1099, whether that 1099 is for capital gains reporting or it's for income reporting or any other form of 1099, you want to reconcile that tax documentation to your accounting. And firstly, determine its accuracy. Secondly, ensure that when you're reporting this on your tax return, you're reporting it appropriately based off of the 1099s and any potential adjustments that may need to be made to those 1099s based off of your accounting and cost basis information that you may have. These 1099s aren't always accurate, so oftentimes when we report them, we do have to report them with adjustments or corrections, but they still should get reported so you don't have compliance issues from a tax reporting perspective when the IRS is matching your tax return with the 1099s being reported. So number one is we want to make sure that we're reporting the 1099s and that we're reconciling them back to our accounting. One thing to be careful here is that you don't want to report the 1099 and then also report the same activity off of your accounting without reconciling the two, because this can lead to double reporting potential income or capital gains and actually overstating your taxes. Likewise, you don't want to neglect reporting the 1099, because then even if you're reporting this information off of your financial statements, the IRS may perceive that you're underreporting based off of the 1099 that's not being reported. So you want to make sure that that's all congruent. Web3 businesses that make this accounting mistake complicate their accounting unnecessarily, create a high risk of inaccuracies in their accounting, and overall just really hurt their financial statements. And that is commingling funds, specifically commingling business funds with personal funds are commingling multiple businesses together. What commingling means is basically just mixing funds together. So how this usually looks is either in a wallet or a bank account or both. So commingling in a wallet can mean you may own a wallet, and that wallet, maybe it's personally owned, maybe it's owned by your company, but you're mixing in transactions that are business related transactions and personal transactions. And there's usually a reason that this happens to someone. There's usually a practical reason where they're using their wallet to facilitate some type of payment or custody of funds, or they have a wallet set up on a specific blockchain, and it's just for practical reasons from an operational perspective, it makes sense for them to use that. But this commingling issue really hurts you from an accounting and tax perspective, because you're going to come to Camuso CPA, or you're going to bring your transactions to your digital asset CPA, and they're all going to be jumbled together. It's going to be just a mix of transactions between you personally and your company, and we're going to have to work through parsing out all of those transactions and determining what is business and what is personal. And there's almost never a simple or easy way to do that without really going through the transactions and determining with you as the client, which ones are personal and which ones are business. So it becomes a very manual process. It becomes a very error-prone process. And as a result, it raises the risk of inaccurate financial statements and inaccurate tax reporting. Additionally, depending on the nature of the commingling and the context of how the funds move, there also could be potential negative tax implications, or at least tax complications from moving from funds from the business to personal in this type of manner where you're commingling funds. So you really want to avoid this. It's going to really hurt the integrity of your accounting system and your overall accounting accuracy, and it's going to make your life a nightmare when it comes to reconciling your accounting activity and getting an accurate set of financial statements. Web3 businesses that are serious industry players that want to be here for the long term cannot afford to neglect their digital asset accounting system. And there's multiple reasons why this is foundational to the success of your company. Firstly, without a well-established and well-implemented digital asset accounting system, you're never going to have an accurate set of financial statements to make business decisions based off of. Whether these are cash flow projections or any other business decision, your starting point is always going to be your financial statements. And if you don't have an accurate set of financial statements, you're going to be making all of your business decisions blind. Additionally, you may be fundraising for your Web3 business. One of the first things that your investors are going to request from you is your financial statements, so they can determine the health of your business and project out the profitability and cash flows related to your Web3 business. This can't be done without an accurate set of financial statements. So right away, if you want to be able to make accurate business decisions, and if you want your investors to be able to make business decisions and investment decisions related to your business, you're going to need to have accurate professional financial statements that can present your company in a true and accurate perspective. Additionally, if you don't have these financial statements and they're requested from an investor or another professional that you're creating a business relationship with, this can hurt your business reputation, because your accounting is such an important part to your business decision-making ability that if you don't have this in good order, it can bring into question the overall health of your business. Because if you don't have these financial statements, what else could you possibly be doing wrong, and what other decisions can you be overlooking when you're not making the decisions based off of the correct data? Lastly, from a tax reporting perspective, it's imperative to have accurate financial statements. we need to be able to accurately report our tax positions on our tax return and substantiate them in the event of an audit. So from a tax reporting perspective, from a business decision-making perspective, and also from a reputational perspective, it's imperative that you have a well-implemented and well-managed digital asset accounting system. Does your Web3 business need professional assistance from a experienced digital asset CPA firm in establishing and managing your digital asset accounting system? If so, contact me and my team at Camuso CPA today. We work nationwide with Web3 businesses and digital asset investors on digital asset accounting and digital asset tax reporting and tax planning. Through my firm at Camuso CPA, we have been working with digital asset investors and businesses transacting with digital assets since 2016. We were the first firm to accept cryptocurrency as a form of professional payment in 2017. Our firm has a very long track record of working specifically with digital assets. All of our clients are digital asset investors or Web3 businesses. We've been here from the beginning of this industry and can help you regardless of the level of complexity within your digital asset transactions or your digital asset accounting needs. So contact Camuso CPA today, and I'd be happy to speak with you to determine if we're a good fit to work together based off of your company's needs.